Have you ever felt that sort of hum in the financial world, that feeling like something big is about to shift, something that could change things for, well, everything from your house payments to maybe some of your more speculative investments?
Hmm.
Well, you're probably not wrong. Today, we are doing a really critical deep dive into exactly one of those huge shifts
Hmm.
at the U.S. Federal Reserve. They're widely expected to start cutting interest rates, and we want to explore the profound, really far-reaching impact of that.
Yeah, they're big.
And our focus, really getting under the hood of what this means for you, especially if you're anywhere near the crypto market, which is, let's face it, always dynamic, often unpredictable.
Right.
We've gone through, mountains of sources, detailed economic reports, top-tier financial analysis, the latest crypto market insights, basically trying to cut through all the noise and give you a clear, actionable picture.
And that's exactly the mission here. This isn't just about, repeating headlines. We're aiming to unpack the really complex and honestly increasingly tangled relationship between traditional finance, the Fed's monetary policy, and this constantly evolving crypto world.
Tangled is a good word for it.
It is. So we're going beyond just if the cuts will happen. We want to know what they actually signal for the markets, how similar moves have played out historically across different assets, and crucially, where this might realistically lead us and your portfolio in the coming months, maybe even years.
Okay.
The goal is to give you clear, contextual insights, maybe a few surprises, those little aha moments,
Yeah.
so you feel genuinely informed, but hopefully without drowning in technical jargon.
Yeah. Keep it understandable.
Exactly. Think of it as understanding the ripple effects, these huge macroeconomic shifts, how they wash across your entire investment landscape, from Bitcoin all the way out to the fringes of DeFi.
All right, so let's really dig into this huge shift. For what feels like ages now, we've been sailing in financial waters dominated by these aggressive interest rate hikes from the Fed.
Relentless is the word.
Yeah, it really felt like it.
Yeah.
A dominant force hitting everything cost of buying a home, how much companies could borrow. We all remember why they did it, right? The main reason was that fierce fight against inflation.
Which was soaring. Multi-decade highs. Uncomfortable territory.
Absolutely. So the Fed's playbook was pretty straightforward then. Make money more expensive, cool down the economy because it was just running too hot.
Right. Classic monetary tightening.
But now the whole story isn't just shifting. It feels like it's doing a full 180-degree pivot. The general agreement now among economists, market watchers, is that the Fed is actually getting ready to start cutting those rates.
The expectation is definitely baked in now.
So the big question for us, for you listening,
Yeah.
why? Why this kind of abrupt change? What are the economic signals really pushing them in this new direction?
It's such a delicate balancing act, isn't it? And what's really fascinating here is how the Fed is trying to walk this tightrope. They need to make sure inflation stays down, but they absolutely do not want to accidentally smother the economic growth they're supposed to be nurturing.
Right, the dual mandate.
Exactly. So this potential move towards cuts, it's really driven by a few key economic indicators coming together. First, and probably the most important one, inflation itself. The very thing that forced those hikes, it is cooled significantly by most measures.
We've seen the numbers drop, CPI, PCE.
Precisely. Especially PCE, which is the Fed's preferred gauge. We've seen a pretty consistent downtrend. Now, are we totally at the 2% target yet? Maybe not quite everywhere, but the direction is clear. The pace of price increases has really stabilized across the board.
Yeah.
That takes off some immediate pressure.
Okay, so inflation's less of a raging fire. What else?
Second point, the job market. Despite that really aggressive tightening cycle, the most aggressive in decades, the labor market has been incredibly resilient.
Yeah, unemployment stayed low, surprisingly low to many.
Stubbornly low. It defied a lot of predictions. That strength gives the Fed a really important cushion. It suggests the economy can handle some policy adjustment without immediately triggering mass layoffs or something drastic.
So strong jobs provide some breathing room.
Right. But then there's the third piece, and this one's getting louder. The worry about a hard landing, or even, tipping into a full-blown recession if they keep rates too high for too long.
Ah, the risk of overdoing it.
Exactly. There's a real fear that keeping money expensive for an extended period could start to really squeeze business investment, maybe dampen consumer spending too much, and ultimately cause an unnecessary contraction.
So it's about preventing that downturn.
That's becoming the focus. Remember that dual mandate. Maximum employment and stable prices. With inflation looking more under control and employment still strong, their objective seems to be subtly shifting. It's moving towards proactively supporting sustainable growth and, this is the key phrase, engineering that soft landing.
The elusive soft landing. Easier said than done historically.
Oh, incredibly rare, which raises that big question. Can they actually thread this needle? Can they ease rates just enough to keep the economy going without, reigniting the inflation they just worked so hard to put out? History suggests it's a very, very difficult trick to pull off. It makes watching their next moves absolutely fascinating. High stakes, really.
That distinction, fighting inflation versus actively trying to engineer a soft landing, that feels really crucial. And like you said, it highlights the razor's edge they're on. And this expectation of cuts, it's not just like random speculation, is it?
No, not at all. It's deeply rooted in serious economic analysis and, maybe most revealingly, if you really scrutinize the minutes from the Federal Open Market Committee meetings, the FOMC minutes.
Ah, the Fed watcher's favorite reading material.
Exactly. When analysts pore over those documents, they're not just looking for the headline decisions. They're dissecting every subtle shift in language, especially around forward guidance. They look at the nuanced phrasing about future economic projections, and crucially, those individual member forecasts the dot plot, showing where each member thinks rates are headed.
The tea leaves of monetary policy.
Pretty much. That's where you spot the signals about their longer-term intentions for inflation, jobs, growth, often months before a formal announcement. It really points towards a strategic, well-thought-out pivot happening.
And the basic mechanism here, lower rates stimulating the economy, how does that actually work in simple terms?
Well, at its core, it's about the cost of borrowing. Lowering the Fed's target rate makes it cheaper for banks to borrow money, and that lower cost tends to ripple out through the entire financial system. So mortgages get cheaper, car loans get cheaper, businesses find it less expensive to borrow for expansion or new equipment. It basically incentivizes spending and investment. It's the main lever the Fed has to either cool things down, like they did with hikes, or, like now, potentially inject some life back into an economy that might be slowing down. Simple concept, incredibly powerful effects.
Okay, so let's zoom out a bit. If the Fed does cut rates, what are the broader sort of ripple effects across the whole economy? The most obvious one seems to be that cheaper borrowing you just mentioned.
Absolutely. That's the most direct consequence. Lower interest rates mean cheaper borrowing costs, pretty much everywhere.
So for, regular people, what does that look like?
Think about mortgages. Rates might come down, making buying a house more affordable, or maybe refinancing what's attractive again. Car loans get cheaper. Even the interest you pay on credit card debt could potentially ease off a bit.
Right, so it potentially frees up some money in people's budgets.
Exactly. Or it just makes those big purchases seem more manageable. Either way, it tends to encourage consumer spending, and consumer spending is, the engine of the U.S. economy, roughly 70% of it.
Okay, so it boosts the consumer side. What about businesses?
Huge impact there, too. Cheaper borrowing is a massive incentive for corporations. Suddenly, funding that new R&D project or expanding a factory or investing in new tech or even just hiring more people, it all becomes less costly.
The hurdle rate for new projects drops.
Precisely. This lower cost of capital acts like a stimulant. It encourages companies to invest, to innovate, potentially leading to more job creation down the line. It's like getting a discount on the fuel for the economic engine. Makes expansion look a lot more appealing, right?
Yeah, definitely makes sense. It lowers the barrier to taking risks, basically.
It does. But, and this is important, this discount isn't always applied evenly or instantly. It really matters how it flows through different layers of the credit markets, from ultra-safe government bonds all the way down to, say, venture capital. And those secondary effects, especially on risk appetite, further out, that's where it gets particularly interesting for our conversation.
Right, the knock-on effects.
Those are key. And connecting this to the bigger picture, one of those critical things to watch is what happens to the U.S. dollar. Rate cuts often, though not always, lead to a weaker dollar. We usually track this using the dollar index, the DXY.
Okay, the DXY against that basket of other currencies.
Exactly. The euro, yen, pound, Canadian dollar, krona, Swiss franc. When U.S. rates are high compared to other countries, international investors tend to want dollars to buy U.S. assets and get those higher yields. That strengthens the dollar.
Makes sense. Money flows to where it gets the best return.
But when U.S. rates start to fall, that attraction fades. The dollar might weaken against those other currencies. Yeah. And the consequence of that, a softening dollar, can really change investor behavior.
How so?
A weaker dollar often pushes investors to look for hedges. Assets that tend to hold their value or even go up when the dollar is falling, or maybe when there's just general uncertainty about fiat currencies.
Like gold. That's the classic.
Gold is the textbook example, yeah. A store of value for thousands of years.
Hmm.
But what's really striking, especially in the last decade or so, is how Bitcoin has increasingly stepped into that conversation as an alternative hedge. A newer one, sure, but recognized.
So people see it as like digital gold in that context.
Increasingly, yes.
Yeah.
We've seen this play out multiple times now. You look at charts of the DXY versus Bitcoin,
Mm.
there's often a noticeable inverse relationship. When the dollar weakens, Bitcoin often strengthens, suggesting investors are rotating capital into these non-fiat decentralized assets. It really bolsters the narrative for assets like Bitcoin, positioning it as this potential digital counterpart to gold, especially for people worried about, long-term currency debasement or just wanting diversification away from the dollar system. And it's not just a story. You can often see this reflected in correlation data during periods of dollar weakness and falling real interest rates.
Okay, and this is where it gets really interesting for you, the listener, especially if you're anywhere near the crypto space. Because lower rates aren't just about cheaper loans or a weaker dollar. They fundamentally pump more money, more liquidity into the whole financial system.
A rising tide of capital.
Right. When borrowing is cheap and money is easy to get, there's just more cash floating around, looking for a place to go, looking for a return. And where does that extra liquidity often end up?
It tends to gravitate towards risk assets.
Exactly. Categories of investments that offer the potential for higher returns, but also come with more volatility, more risk. In traditional markets, what does that usually mean?
Typically, stocks do well, especially growth stocks. Tech stocks often lead the way in that environment.
But critically, that wave of liquidity doesn't just stop at the stock market's edge, does it?
No, absolutely not. It inevitably spills over, sometimes quite dramatically, into crypto assets.
Yeah.
The crypto market, with its, let's be honest, high volatility but also potential for massive asymmetric gains, becomes a prime target for that influx of capital. Historically, when there's more money just sloshing around the system, a good chunk of it finds its way into speculative growth-focused investments.
And crypto's definitely seen that way by many.
Oh, absolutely. From the big names like Bitcoin down to the smallest, newest altcoins, they're often viewed as the ultimate expression of that risk-on sentiment. It transforms crypto from just a niche hobby into potentially a major destination for global capital when investors are chasing yield and growth in a low-rate world. And what's really insightful here is watching how Bitcoin, specifically, acts almost like a sophisticated gauge for the whole financial weather system. It's not just reacting to the raw amount of money, the liquidity. Its performance seems very closely linked to this more nuanced idea of real yields.
Okay, real yields. Let's break that down quickly. That's the return you get after accounting for inflation, right?
Exactly. A simple way to think about it is taking the nominal yield on something like a 10-year Treasury bond and subtracting the rate of inflation, maybe measured by CPI or, as the Fed prefers, PCE. That gives you your real return.
Got it. So how does that connect to Bitcoin?
Well, Bitcoin has shown this really strong historical tendency to rally when those real yields go down.
Why is that? What's the mechanism?
Think about it from an investor's perspective. If traditional safe investments like government bonds are offering a real return that's very low, or maybe even negative, meaning they aren't even keeping pace with inflation.
You're actually losing purchasing power by holding them.
Precisely. When that happens, the opportunity cost of holding an asset that doesn't pay a yield, like Bitcoin, goes down significantly. Why hold a bond that's losing value in real terms when you could hold an asset with potential for high growth, even if it doesn't pay interest?
Right. The comparison becomes more favorable for Bitcoin.
Exactly. Capital naturally starts looking for alternatives, assets that might not just preserve purchasing power but actually grow it. And this isn't just a small effect. Think about large institutional portfolios, pension funds, family offices. When real yields sink, it forces them to fundamentally rethink their traditional safe asset allocations. They start looking for that asymmetric upside potential, hunting for real returns, and that's often when assets like Bitcoin appear on their radar.
And you can see this in historical data.
Well, yeah, there are some compelling analyses comparing Bitcoin's price moves against Fed rate changes over multiple cycles. They often show this inverse relationship with real yields quite clearly, especially when real yields dip below zero or even below -1%. Historically, that's often been a pretty powerful catalyst for money moving into non-yielding digital assets like Bitcoin.
That distinction between nominal and real yield is so important. It explains a lot about capital flows. Okay, so if Bitcoin is maybe the main engine here, the rocket establishing the path, what about Ethereum, ETH, and all the other altcoins?
Yeah, that's a great analogy. If Bitcoin is the rocket, then ETH and the wider altcoin market can often act like the booster stages. They tend to amplify the market's moves.
So if this overall risk appetite comes back strongly because of rate cuts and liquidity,
Then altcoins could potentially benefit even more than Bitcoin, percentage-wise.
why is that? Is it just because they're smaller?
Partly, but it's more about their beta. In finance, beta measures how much an asset's price tends to move relative to the overall market. Altcoins are generally considered higher beta assets.
Meaning they swing more wildly?
Exactly. In a strong bull market, when confidence is high and people are willing to take more risks, altcoins often shoot up much faster than Bitcoin. Of course, the flip side is they tend to fall much harder in downturns too.
Higher risk, higher reward potential.
That's the game. So, as this wave of liquidity and risk appetite washes through the system, investors often become more willing to bet on projects with, let's say, more speculative potential or ambitious growth stories. That often triggers what people call an altcoin season, where money flows down from Bitcoin and Ethereum into smaller cap coins.
Which raises a really practical question for you, the listener. Where does your comfort level sit on that risk spectrum? Are you looking to ride those potentially bigger waves with higher beta alts, or do you prefer sticking closer to the relative stability of Bitcoin and maybe Ethereum? That's a key decision in managing your exposure.
Absolutely. And your point about altcoins as boosters, it connects directly into another really fascinating area. The interplay between traditional finance, TradFi, and decentralized finance, or DeFi. Because here we see a potentially powerful arbitrage opportunity opening up.
Arbitrage? How so?
Think about the risk-free rate in TradFi. That's usually based on things like government bonds, maybe high-yield savings accounts, money market funds. As the Fed cuts rates, the yields on those instruments shrink. They become less attractive.
Right, your savings account starts paying next to nothing.
Exactly. Now, compare that to the yields you might be able to get within DeFi protocols, often on stable coins, digital dollars, essentially. If traditional banks are offering you, say, 0.5% on your savings, but a well-established audited DeFi lending protocol is offering maybe 4% or 5% on a stable coin,
The DeFi option suddenly looks a lot more compelling, doesn't it?
hugely more compelling on a relative basis. Even if there are perceived smart contract risks in DeFi, the yield difference becomes hard to ignore. This creates a really strong incentive for capital to move out of those low-yielding TradFi assets and into the DeFi ecosystem, specifically chasing those higher stable returns on stablecoins.
So you expect more money to flow into things like DeFi lending.
We anticipate increased activity, yeah. In protocols like Aave, Compound, others, wherever investors can find sustainable yield on stable assets. And this isn't just guesswork. We can actually watch for this by tracking on-chain data.
Like stablecoin movements.
Exactly. If we see a big surge in stablecoins moving on to decentralized exchanges or flowing into the major lending platforms, especially right after we see yields really compress in traditional markets, that would be a strong signal that this capital migration is happening. It highlights how DeFi isn't just this separate thing. It becomes genuinely competitive with TradFi when traditional yields are low.
Okay, so we've painted a pretty positive picture here. Cheaper money, rising risk appetite, potential booms for Bitcoin, alts, DeFi. But it can't all be smooth sailing, can it? We need a reality check.
Absolutely crucial. A dose of realism is needed. While the underlying trend, the macro tailwind, definitely seems favorable for risk assets like crypto, we have to acknowledge the volatility caveat.
Markets don't go up in straight lines.
Never. Especially not during major policy shifts like this. There's always the potential for short-term market nerves, maybe even a brief panic. What if, for instance, the market interprets these rate cuts differently?
How do you mean?
What if they're seen not as a proactive move to support growth, but as a reaction, a sign that the Fed sees serious economic weakness ahead, that they're hitting the panic button because things are worse than they look?
Ah, the cutting into weakness scenario.
Exactly. If that narrative takes hold, even temporarily, markets could react negatively at first. We could definitely see a choppy period, maybe even an initial sell-off, as investors try to figure out what the cuts really mean and reassess their own risk.
So, potential for some initial downside.
It's definitely possible. But, and this is important historically, that kind of initial panic often fades. Once the positive effects of the lower rates actually start filtering through the economy cheaper, borrowing, stimulating spending and investment, more liquidity finding its way into assets, the market tends to stabilize and then rebound.
So, the initial reaction might not be the final word.
Usually isn't. The underlying trend, that increased risk-on sentiment driven by liquidity, is likely the more durable force. But you have to be prepared for that potential choppiness. It takes a resilient, sort of longer-term view to separate the market noise from the fundamental shift. Don't get shaken out by short-term volatility if the bigger picture still looks positive. And that long-term perspective you just mentioned is so vital because the impact of these rate cuts goes way beyond just day-to-day price swings. It reaches deep into the actual structure, the architecture of the whole Web3 ecosystem.
Okay, so beyond just prices going up or down, how?
Well, if we connect it back to that bigger picture, this isn't just crypto gets a boost. It's more fundamental. It's about where capital is now incentivized to go looking for returns. And that shift is likely to significantly impact DeFi lending protocols. Think about the big players like Aave, Compound, and others. They seem particularly well positioned to see increased inflows.
Because of that yield differential we talked about.
Exactly. Let's hammer that mechanism home. Traditional finance yields on safe stuff, savings accounts, money markets, short-term bonds, they shrink when the Fed cuts rates. That creates this powerful economic pull. Investors, especially those starved for yield in the traditional world, start looking elsewhere.
And DeFi offers an alternative.
A compelling one. It's like this alternative financial plumbing system that just becomes dramatically more competitive when the old pipes aren't delivering much water, so to speak. So capital flows into DeFi. This strengthens those protocols, which can create positive feedback loops.
Like,
More liquidity in the pools makes borrowing and lending smoother, more efficient. More capital might even lead to lower borrowing costs within DeFi itself, attracting even more users. And that whole environment encourages more innovation, new financial products, new services being built on top.
so it's not just about yield, it's about driving adoption and innovation in DeFi.
Precisely. It helps move DeFi from being this niche experiment towards being a genuinely competitive, maybe even mainstream option for a wider range of investors, especially those really focused on making their capital work harder.
Okay, so DeFi gets a boost. What else in the broader Web3 space?
Well, think about diversification. Lower rates push investors to look beyond just stocks and bonds. And this trend directly benefits one of the really exciting, growing areas in digital assets, the tokenization of real-world assets, RWAs.
Putting things like real estate or commodities on the blockchain.
Exactly, or precious metals, art, maybe even intellectual property. When traditional assets are offering lower returns, investors are naturally more open to exploring these new frontiers. They're looking for better yields, sure, but also just better diversification.
And tokenization helps with that.
Massively.
Mm.
RWA tokens are potentially revolutionary because they can allow for fractional ownership of assets that were previously really illiquid or had super high barriers to entry.
So you could own like a tiny piece of an office building or a famous painting.
That's the vision. And you could potentially trade that token easily on a blockchain. The lower rate environment makes investors more adventurous, more willing to look at these innovative structures. It's effectively bridging that gap between the old world of traditional finance and the new world of decentralized systems.
So what does this all mean for you as an investor navigating this?
It means that this idea of digitally representing physical assets isn't just some tech fantasy anymore. It could become an increasingly important investment avenue, blending your physical world assets and your digital investments into maybe one more cohesive strategy. It opens up totally new ways to build a portfolio.
Very interesting. The lines are definitely blurring. Now, you mentioned earlier how Bitcoin is attracting attention beyond just retail investors. What about institutions? How do rate cuts play into that?
This is where things get really fascinating, I think. And it really speaks to how much the crypto market has matured. It's not just driven by individual enthusiasts anymore. There are now these institutional frameworks being built, almost like superhighways, allowing massive amounts of capital to flow in, and these flows are directly influenced by these macro shifts.
So rate cuts could accelerate institutional adoption.
Very likely. We're talking about the potential for significant capital rotation from traditional assets into the crypto space by major players, think multi-billion-dollar hedge funds, large asset managers, maybe even conservative players like pension funds eventually. They might start increasing their allocations to Bitcoin, to Ethereum, and maybe most significantly, to those recently approved crypto ETFs.
Why ETFs specifically?
Because they solve a lot of problems for institutions. This rotation becomes especially likely if those real yields we discussed compress even further. For huge institutional portfolios that need to deploy billions and are constantly optimizing risk-adjusted returns, holding traditional low-risk assets that barely beat inflation or don't even beat it becomes really unattractive.
So they need alternatives that can actually generate returns.
Exactly. And regulated products like the spot Bitcoin ETFs provide a structure they understand. It's familiar, it's audited, it's accessible through their existing brokers. It allows them to get exposure to crypto without having to deal with the headaches of direct custody, complex compliance, or setting up new operational processes.
It lowers the barrier for the big money.
Massively. And that intensifies the impact of liquidity on crypto by orders of magnitude. We're not talking about small retail buys anymore. We're talking about institutional capital, potentially moving in chunks of hundreds of millions, even billions, flowing through these established TradFi pathways. You can actually track this starting to happen through data providers like CoinShares, looking at their weekly digital asset flow reports, or reading research from firms like Masari, who constantly analyze this macro crypto connection.
So it's not just about the price going up, it's about the fundamental structure of global finance starting to incorporate digital assets as a real and maybe even necessary component.
That's exactly it. It's a sign of maturation, a really profound shift underway.
You know, they say history doesn't repeat itself, but it often rhymes. That feels particularly true when you look at these big macroeconomic cycles, doesn't it?
Oh, absolutely. The patterns can be remarkably similar.
And thinking about rhymes, if we look back at that period, roughly 2020 to 2021, when we had basically zero interest rates, or near zero.
The ZIRP era zero interest rate policy.
Right. Those rhymes start sounding pretty loud, almost deafening. That whole era was defined by ultra-loose monetary policy, quantitative easing, just an incredible amount of liquidity flooding the system. And what happened in crypto?
It fueled the biggest bull run in Bitcoin and DeFi history. Pretty much undeniable.
Yeah, it wasn't just a coincidence, was it? It felt like a direct consequence. A powerful, real-world case study. We saw just explosive growth, crazy innovation in DeFi. NFTs took off.
Yeah.
The whole crypto world burst into the mainstream consciousness. So those conditions back then, driven by all that easy money, they really do offer a potent glimpse of what might be possible again if we see a sustained period of lower rates, right? Remember that wild ride?
Hard to forget.
It wasn't just random luck. The low-rate environment massively inflated asset prices pretty much everywhere, making those speculative growth assets incredibly attractive. And crypto, with its built-in volatility and huge upside potential, was arguably the single biggest beneficiary. It showed a really clear, observable link, a central bank policy directly impacting digital asset performance.
That 2020-2021 period is definitely a powerful reference point. But, beyond just the sheer scale of the growth, there was another more recent event that raises maybe a more fundamental question about crypto's role.
Oh, which event was that?
The banking crisis back in March 2023. Remember Silicon Valley Bank, Signature Bank?
Yeah, that felt pretty unstable for a moment there. A lot of nervousness.
Exactly. And during that period of real stress in the traditional banking system, we saw this surge in what the market called Fed pivot fears. The expectation grew rapidly that the Fed would have to loosen policy, maybe cut rates or stop hiking, just to stabilize things and prevent a wider contagion.
Okay. And what happened with Bitcoin then?
Bitcoin's price got a significant boost. Now, what was really interesting was how it behaved. Even as the broader market was jittery and traditional finance was clearly in crisis mode, Bitcoin seemed to act almost like a flight to safety asset.
Really? Not just another risk asset selling off?
It didn't behave like one then. When the stability of actual banks was being questioned, capital seemed to flow into Bitcoin. It challenged that long-held idea that Bitcoin is only a high-risk speculative bet.
So it acted more like a safe haven in that specific crisis.
It certainly behaved that way. It forced a lot of people, especially institutional strategists, to seriously reconsider Bitcoin's role. Could it actually be an uncorrelated asset, something that offers refuge when the traditional system is under duress? The 2023 crisis provided some compelling evidence that, under certain conditions, the answer might be yes. It adds another layer to the Bitcoin narrative.
That's a really significant evolution in how people might perceive it. And speaking of narratives and assets that offer refuge, it feels natural to draw a parallel here between Bitcoin and gold.
The comparison comes up constantly.
Right. They're often viewed differently, one ancient, physical, the other new, digital. But in terms of how they react to monetary policy shifts, they actually show some remarkably similar patterns, don't they?
They really do. Both gold and Bitcoin have historically shown this tendency to rally when interest rates are falling. especially real interest rates. Gold's been a classic inflation hedge, the ultimate store of value for millennia. It often does well when the real return on holding cash or traditional bonds goes down.
And Bitcoin seems to be following a similar script.
Increasingly so. As this sort of emergent digital store of value, it's mirroring that dynamic more and more. You used the analogy earlier, think of them as different ships, but they're sailing in the same macroeconomic winds. Both tend to catch a nice tailwind when central bank rates are dropping and liquidity is easy.
So it reinforces that idea of Bitcoin as a legitimate digital alternative, especially when people are worried about fiat currencies or just looking for something outside the traditional system.
Exactly. And again, it's not just a story. You can often see it in correlation studies. Their responses to things like real yields and dollar movements are often quite aligned, though not perfectly, of course.
Okay, so we have historical parallels of evolving narratives. What about the infrastructure? You mentioned ETFs earlier. How crucial are they in this whole picture connecting macro policy to crypto flows?
Oh, they're absolutely transformative. This speaks volumes about the market maturing, the significance of those huge ETF inflows, especially what we saw starting in 2024 and likely continuing. It just cannot be overstated.
Because they make it easy for big money to get involved.
Precisely. Those surges in institutional demand are directly linked to periods of easy money, abundant liquidity. When rates are low, capital is plentiful, these big institutional investors, pension funds, sovereign wealth funds, big hedge funds, they're far more willing and, frankly, need to allocate funds to new asset classes to find returns, especially assets that might offer uncorrelated returns.
And the ETFs provide the perfect vehicle.
The perfect wrapper. It's regulated, it's accessible, it uses infrastructure they already know. They don't have to worry about custody-specific crypto compliance hurdles. It removes massive friction points.
So it just opens the floodgates for institutional money when the macro conditions are right.
It intensifies the impact exponentially. Billions can flow in through these familiar channels. It really does mark a new era. These macro policy shifts by the Fed can now translate much more directly and much more powerfully into huge, sustained capital flows into the digital asset world. The plumbing is now in place for that institutional wave.
And just to make sure we're not being too U.S.-centric here, does this dynamic play out elsewhere? Do we see similar things in other parts of the world?
That's a great point. Yes, absolutely. It's insightful to look at emerging markets, for example. There are plenty of historical cases where aggressive rate cuts in those economies have triggered significant flows into alternative assets. And in recent years, that increasingly includes crypto.
Why is that particularly the case in emerging markets?
Often, investors there face even more pressure. Maybe their local currency is unstable, or traditional investment options within their own country offer really poor returns, perhaps eroded by high inflation. In those situations, investors are often much quicker and more aggressive in seeking out assets anywhere in the world that can actually preserve or grow their wealth.
So crypto becomes an attractive option for them too.
Definitely. It's not just an isolated phenomenon in the US or Europe. It reflects a truly global investor tendency. The underlying forces we're discussing, the hunt for yield, the desire to escape currency debasement, the appetite for growth when traditional options look weak, these are universal drivers. It shows how interconnected global finance is and how central bank policies, especially the Feds, ripple outwards and influence investor psychology everywhere. Hashtag #tag out an outro.
Okay, so we've covered a lot of ground here. After this really deep dive, let's try to boil it down. What does this all mean practically for you listening, for your financial outlook?
Yeah, let's synthesize.
The core idea seems to be the Fed looks likely to pivot towards cutting rates. The main driver is wanting to avoid a major economic downturn, a hard landing. And that big policy shift is expected to ripple outwards, right?
Cheaper borrowing costs across the board,
A potentially weaker U.S. dollar.
which pushes investors towards alternatives.
And maybe most importantly, just a big boost in overall liquidity, more money flowing through the system.
Exactly.
And all these factors together seem to create a generally positive, maybe even robust environment for risk assets. That includes Bitcoin, Ethereum, the broader altcoin market.
The growing DeFi space, even things like real-world asset tokens.
And underpinning all of that is the potential for much larger, more sustained flows of institutional money coming in, really cementing crypto's place in the wider financial world.
That sums it up pretty well, but it also leaves us with a really profound question to think about.
Yeah.
As these lines keep blurring between traditional finance and this rapidly evolving crypto world driven by these huge macro shifts, How might your own personal understanding of what constitutes value, or even what a safe haven asset is, how might that evolve in the coming years?
Interesting.
Will this next phase, if it is indeed fueled by easier money, will it really kick off another massive bull run like we saw in 2020, 2021, with that kind of huge growth and adoption? Or are there other factors out there? Maybe inflation proves stickier than expected, maybe some geopolitical curveball, maybe new regulations. Could those things temper the enthusiasm, lead us down a more complicated, maybe more volatile path?
So history rhymes, but maybe not perfectly this time.
It's the big question, isn't it? It's a genuinely fascinating and definitely pivotal moment to be watching all this unfold. These huge tectonic plates are shifting under us. It creates incredible opportunities, but also some complex challenges to navigate.
Indeed. These are exactly the kinds of questions that will shape our financial future. Before you dive deeper into mulling over these ideas, maybe rethinking your own strategy, please do make sure you like, subscribe, hit that notification bell.
Yeah, it really helps us out.
It lets us know these deep dives are hitting the mark for you, and it helps us keep bringing you the analysis on the topics that really matter. We really appreciate you joining us for this crucial conversation on the deep dive.